Good morning, students. Today I am going to explain Module 6. This is about marshalling of balance sheet. Now, what is marshalling of balance sheet? Marshalling of balance sheet is simple, meaning that is arranging items in the balance sheet. There are different methods, especially I can tell you that there are two methods of arranging items in the balance sheet. So, marshalling of that we are going to see in detail in the next slide. So there what you have to remember is that arrangement of items in a balance sheet in a proper way. Proper way is the two methods what we are going to learn, that is called the marshalling of balance sheet. So there are two types of arranging items in the balance sheet. One is liquidity order, second is permanency order. So now we will see these items in detail. What is liquidity order? Liquidity order, as the name indicates, the more liquid assets will come first, followed by the fixed assets. Similarly, the earliest payment, the more liquid payments, that is the current liabilities will come first, followed by fixed liabilities. That will be the liquidity order. So if we repeat that, more liquid assets on the current asset side. That means current assets, cash in hand, cash at bank, all the more liquid assets will come in the current assets, and then the fixed assets like plant, machinery, etc. Similarly, on the liability side, as the order of payment, current liabilities, current bills payable, all this current liabilities will come. Then after that, the long-term liabilities will come. So liquidity, if you see the liquidity order of balance sheet, liability side, I have given the format. Current liabilities will come first, followed by long-term liabilities, and total will be the amount. If you see the asset side, first item will appear as the current assets, followed by fixed assets. Now, if you see the second type of marshalling of balance sheet, that is the permanency order. As the name indicates, how we want to keep the assets in the balance sheet. That means fixed assets we are buying in the business to keep that forever. We have no intention to sell that. So when you are arranging items in the balance sheet as per the permanency order, fixed assets will come first and followed by current assets. Then capital, if you see the liability side, capital we are keeping. We have no plan to pay off the capital. So capital will come first in the liability side and current liabilities will be followed second. And you have to remember that joint stock companies follow permanency order for presenting their balance sheet. So when I am explaining the problems also, in my problems, what I am following the permanency order, because that is the most followed method of preparing items or marshalling items in the balance sheet. Now I'll explain there are different types of assets and liabilities mentioned in the balance sheet. So that I'm going to explain. So what are liquid assets? Liquid assets meaning it can be converted into cash. So that you have to remember without much loss in value. Cash in hand and cash at bank. Without any loss in value we can take it. So that is the liquid assets. Other liquid assets are bills receivable and debtors. So these things you have to remember. This may be important for 2 marks. Next is what is current assets. So current assets which can be converted into cash. Whereas when you sell this, there will be some loss in value. All liquid assets are current assets. But you have to remember that stock, if you want to sell, you can sell that. But you can always sell at a loss. Similarly, prepaid expenses. Say for example, insurance you prepaid. So that if you want to convert it into cash, it is not possible. So this stock and prepaid expenses that can be converted into cash but at a loss. But always remember that prepaid expenses. See for example, if you have paid insurance premium in advance, you cannot recollect it from the insurance company. It's a loss only. But stock you can sell it at a loss. Next is fixed assets. Fixed assets, you know that if here it will increase the earning capacity of the business. And whenever the business is buying a fixed assets like building, plant, machinery, vehicle, anything, they are not meant to for resale. They always want to retain in the business because it will increase the earning capacity of the business. Examples are plant and machinery and furniture. Next is wasting assets. Wasting asset meaning, as the name indicates, value of assets goes down when you extract things from that. So the best example is mines and quarries. As you extract the quarry output from that, the value of the asset will go down. So that is called wasting assets. Next is fictitious assets. These terms are very important, because when we are preparing the balance sheet, we will classify the assets under these heads: fixed assets, current assets, liquid assets, fictitious assets. Similarly, liabilities also: current liabilities, fixed liabilities. So these terms are very important, especially it's important for 2 marks also. So fictitious assets meaning not real assets. So these assets are present in the business, but it's not, we cannot see that, we cannot touch that. Example, debit balances carried forward. Say for example, preliminary expenses written off. When you start a business, we have to incur so many expenses. So that we have to write off in 5 years. Or discount on issue of shares. This is incurred at the time of starting the business, but we are writing off over a period of 5 years. So these are fictitious assets. This amount we have seen, but over the years only we are writing off, because we are going to get the benefit for a number of years. Now, fixed liability. Now we are coming to the liability. Fixed liability. Fixed liability meaning it's long-term indebtedness. That is proprietor's fund, the capital he is bringing, or long-term loans, reserves and surplus. So these are long-term indebtedness. So that is the fixed liability. When a proprietor is bringing fund, we have no intention to repay it back to the proprietor. That will remain in the business. Similarly, long-term loans from banks. We want to acquire it for a number of years so that we can take the benefit of that loan. So that is a fixed liability. Next is current liability. Current liability meaning liabilities are to be paid in 1 year. These examples are creditors, bills payable, short-term loans. We can also say that bank overdraft also is a current liability, because some arrangement with the banks usually or bank overdraft over a period of 6 months they have to repay. But that will vary from business to business. If the business has got credit worthiness, that 6 months can be extended. So that is the current liability. So liability side we have fixed liability and current liability, but asset side we have current assets, fixed assets, liquid assets, fictitious assets, all this, wasting assets. So these categories are important when we prepare the balance sheet. So this is then contingent liabilities. So contingent liabilities, you have to remember liabilities which may or may not arise in future. See for example, see these items. Sometimes it's based on some future events. We cannot predict the outcome of the future event. Say for example, it's a court case. See if somebody has given a court case against the company. So still the litigation is going on. If it is in favor of the company, they may not have to face anything, any liability. But if it's against that, they may have to face that. That means they have to make payment. So this will appear as a footnote in the balance sheet. So contingent liabilities, it will not come in the balance sheet, but it will appear as a footnote in the balance sheet. Now why we are giving it as a footnote in the balance sheet? You have to remember that, because financial statements, why we are giving it to the general public? They have to remember that we have to be transparent. All the possible information we have to give it to the general public. So that is the idea of giving the financial statements. So you have to remember that financial statements we are preparing with the idea of giving maximum information to the general public. So with that idea, we are preparing the balance sheet. So if there is a contingent liability which may arise against the company, so they will show as a footnote in the balance sheet. So this is what I want to explain with this module. Thank you.